This is the most broad, as I said, asset bubble of all time, with 3.5 of the 4 major asset classes clearly in severe bubble territory.
Right.
And thinking that you have no alternative but pick between one of the 4 bubbles is a pretty grim way to view life. I get the argument, so pick a bubble, they'll all go together probably, and you will suffer a lot of pain. And the intellectual content of that argument, that they were all bubbles, so we had to pick the least bad one, will resonate in your head as the market unravels.
Is there any way that these bubbles can kind of, just can self-correct, and so that it's not some sort of an Armageddon scenario? Or what is your scenario?
If you had a dozen to 15 years of flat market with earnings doing okay and rotation within the market, everything would work out fine. And every portfolio manager I almost ever met has felt in market bubbles that could happen. It just never does. The market abhors long sideways movements, as we all know. It either goes up more than you think or down more than you think. You can always hold out hope for an extended sideways movement, but it never seems to arrive. Well, I would look around and ask the question, what is the least bad? And the least bad is emerging markets. It's a little overpriced, absolutely, but it is at one of its 3 points of maximum difference to the S&P 500. And each of the other 2 examples worked out wonderfully well in favor of emerging markets. Conversely, when emerging markets was at a peak, which it was in 07, it sold at a premium PE to the S&P. You can have very bad things happen, which they did. But emerging markets is relatively very cheap and pretty much close to fair value. And the other thing is value versus growth. Low growth stocks have been pummeled by high growth stocks for the decade ending in 2019. And then in the year 2020, they had the worst year by far ever. So you had the worst decade followed by the worst year. And the ratio of value or low growth to high growth was also at the co-equal highest, widest it had ever been with 1974. And the outcome after 1974 for value was wonderful. So I would look at the intersection of those 2 ideas. If you could buy the value stocks in the emerging market universe, which after all includes...
Which you can, right?
Which you can, and it includes some very high growth potential countries like China, and collectively they will have a higher growth rate than the developed world, almost certainly, and they sell at a huge discount. I would say they are modestly cheap in an S&P world that is extremely overpriced. And you could lock them away for 10 years or 20 years and really expect a decent return, which I would recommend. And since there is no hope of persuading people to actually get out of stocks, that would be the best I could offer. But for those 3 people out there who have a will of steel, I would say also have a cash reserve of 20 or 30%, as much as you can psychologically bear, to take advantage of much cheaper prices sometime in the not too distant future.
So would that be your one investment for a long-term diversified portfolio at this particular point, is to have a stash of cash?
No, I would have low growth emerging markets as much as I could stand.
All right.
And a cash reserve as much as I could stand. And if you had 70-30, 30 cash and 70% cheap emerging markets, that would be a pretty resilient portfolio, I have no doubt. For the next 10 or 20 years, though, I think the S&P, of course, will underperform, just as it had a tough time from 2000 to 2010, where it had a negative return. And emerging markets, incidentally, beat it by 11 or 12% a year compound.